Hi everyone. So we are from Pharmaniaga Group. Today we are going to talk about Pharmaniaga. We are going to touch the Pharmaniaga topics in multiple perspectives. So let's hear from everyone. Kamal, how's the industry doing?
Quite robust. Let me walk you through it. So this is the overall view of the supply chain where we will deep dive into the major players. These major players consist of four subsectors: traditional medicines, health and food supplements, over-the-counter products, and also prescription medicines. So the next slide shows the total industry revenue for this subsector, which is about 4 billion ringgit. Next slide, in terms of market share, especially R&D, manufacturing, distribution, with the total of 4 billion ringgit, Pharmaniaga held a big chunk of it with 2.5 billion ringgit, about 64%. This makes sense since Pharmaniaga is a GLC owned indirectly by the government, which acts as the essential local key player in providing accessible medicines to Malaysians. So the next slide, it shows the market value projections of the industry by MIDA. So the local market value was valued about 12.77 billion, and it registered about 9% in the last 7 years. And it is forecasted to reach about 2022 billion by 2024, CAGR about 9.2%. And next slide, SWOT analysis. So the key highlights are the capital flow is top down by the government since the big players are GLC, so it's more efficient. Weakness wise, it tends to have high operation and maintenance costs. Opportunities, healthcare remains vital to the government due to the high spending from its budget. Threats, of course, are the challenges in maintaining profitability because of the high OPEX. With that, let's focus on our company of interest, Pharmaniaga, which is also one of the big players. Lamis, how do you think the company is being managed?
There were some interesting finds in the management discussion. So the first thing worth noting is that in the years analyzed, there were changes on the chairman each year. However, this did not significantly impact the direction of the company. So then in terms of the financial performance, as can be seen from the table on this page, a loss was realized in 2019 despite revenue of 2.8 billion. This was due to the full recognition of costs from a government contract. In 2020, there was significant improvement in the profit before tax. This was due to contributions from the private sector. So now we'll look at the human capital and sustainability strategies. So on the table on the left, you can see that there's a constant growth in human capital despite challenging economic outlook. This shows a commitment to developing talents. So in sustainability in 2019 and 2018, they both focus on similar programs, investing over 4 million ringgit into them. However, in 2020, the focus shifted to business sustainability, where the emphasis of future-proofing the organization was evident. So in terms of the future outlook of the company, I would say it's positive from the achievements in 2020. This is due to the agile way of working, repurposing the plant to produce vaccines. So this indicates it is well poised to pursue avenues of growth. So now that we've seen how the company is managed, let's find out its financial health.
Yes, that was a very interesting analysis, Lamis. Indeed, it is very important for any organization to do their financial health checkup. So, Pharmaniaga is also going to go through the same. So, in this part, there are going to be several analyses that we are going to further dive deep in. But first thing first, I'm going to explain to you guys on the common size analysis. Under common size analysis, there are two types of analysis. One is the horizontal analysis and the other one is the vertical analysis. So from horizontal analysis and vertical analysis, the way that is being analyzed is just the same, which means we are taking the revenue as the baseline, further diving deep into the cost of sales, operating expenses, gross profit and net profits. The only differences here is that for horizontal analysis, the cost of sales shows a very good reduction, which is pretty much relatable with the vertical analysis. The only difference here is that in horizontal analysis, we can see that the gross profit and net profit shows an increase from 2019 to 2020, but in vertical analysis, it shows a decrease. So from here, we can actually look at the percentage difference on how gross profit and net profit differs from the revenue baseline. So these analyses are very useful for Pharmaniaga to have a check on how is their financial health. Next, I will go into the solvency ratios. In terms of solvency ratios, there are three types of criteria that we need to look into. First thing first is the total debt to equity, long-term debt to equity, and the time interest earned. In terms of long-term debt to equity and total debt to equity, It shows a good consistency and it is in a good ratio values to indicate that it has enough cash to cover debts, and it can also be safe to say that investors can invest safely into Pharmaniaga because they have enough cash to cover up their debts. But one thing that you need to always be alert here is on the time interest earned. In 2019, there is a good positive growth, which is 5.69. But in 2020, it shows a negative 0.66 value. Negative indicates here that the company is having some sort of loss. So the value here is not so much, but it is a good indication to Pharmaniaga to take note on how to further see how they can further improvise to have enough cash to cover up its debts. So from here on, let's see Wong has on the table to let us analyze.
All right, let's go down the deeper road of analysis of Pharmaniaga, the ratio analysis. So first thing first, let's look at how efficient this company is turning their current asset into cash. So first, the current ratio. Current ratio is the ability of the current asset to satisfy the current liability. So looking at data of 0.78, it means that for every 1 ringgit maturing debt, Pharmaniaga only have 78 cents of current assets. So it means that Pharmaniaga doesn't have enough of current asset to satisfy its current liability. For asset cash ratio, we only focus on the quick asset, which is the cash and account receivable. So the very low amount in the asset cash ratio is suggesting that the company is over leveraged. So the company might be not having cash and account receivable, but having a lot of inventories, maybe. So the company doesn't seem to have very good liquidity. So while for the efficiency ratio, we look very particular in how efficient Pharmaniaga is using their asset and liability. So the inventory and asset turnover ratio shows that the company is making very good sales. Maybe it's because they're selling vaccine during COVID-19 situation. While for the receivable, they're improving 21 to 19, but this means that the company is earning money faster by collecting their receivable and turn it to buy more vaccines and sell it back after sales. But at the same time, they're pushing away a lot of potential clients because COVID-19, a lot of companies not making money, but they're shortening their receivable time. So people can't pay, so they lost customer. Well, payable turnover ratio and payable turnover in days, they have only average of 40 days, for Pharmaniaga. Means that the companies have been very good in maintaining their reputation and their credit worthiness in their supply chain. So this is a very good sign. So in efficiency ratio, Pharmaniaga is doing pretty good. So how is this company making cash? The company have a very good gross profit margin, is super duper good, but operating profit margin and net profit margin is super duper bad. It means that the company is making very good sales, but very bad net profit margin. It means that the company might be giving a very bad pricing strategy, or they have a very bad control of operation cost. It also can mean that the company is doing a very good corporate social responsibility because they're selling vaccine. So they are very good sales, but they're earning very little. Means that they're not selling a very expensive vaccine to the public of Malaysia. So talking about profitability, we can never forget about the ka-ching part of it, which is the cash flow. So what is the cash flow of Pharmaniaga? Stay tuned.
It is interesting, Wong. Before I proceed to cash flow adequacy ratio, what is actually statement of cash flow tell us, Nadia?
Statement of cash flow is actually a summary of cash inflows and outflows in a given period of time.
Understood. So by doing the analysis of cash flow, we may track and analyze the liquidity and solvency of Pharmaniaga Berhad businesses.
Yup, the analysis contains 3 primary activities, which is operating, investing, and financing.
Red flag, the net income figure was higher than the cash flow for operating activities in 2020 and 2018.
One-time negative figures does not mean Pharmaniaga business is terrible. However, in medium to long run, it significantly reduced revenue.
I actually agree with that. They are actually having an outstanding customer payment all this while.
I was thinking that the business should look into streaming and restructuring payment terms and conditions. Payment must be received before due. By the way, For year 2020, Pharmaniaga is actually make an advance payment for PPE during the pandemic. Slower payment received from Malaysia and Indonesia government hospital also contribute to negative value of operating activities.
Negative value for investing activity for 3 consecutive year, it shows that the company is investing in fixed asset base, which will help the business to generate income growth in the future.
A negative figure for financing activities in 2019. Pharmaniaga on that time borrowed the money to pay the short-term and long-term debt. It is actually a good point to create good stakeholder stake value. How about cash adequacy ratio, Fiona?
The cash flow adequacy ratio for 2018 and 2019 is negative 0.96. However, for 2020, its cash flow adequacy ratio improved to negative 0.66. For the entire 3 fiscal year in total, the cash flow adequacy ratio is negative 1.11, which the cash flow adequacy ratio that less than 1 means that the internal cash sources were insufficient to support the company expenses.